Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing stocks with ex-dividends next week, May 21st through the 27th. So we're going to screen about 50 stocks, starting from the top, knocking off stocks that have a price-earnings ratio over 25. The S&P 500 is at about a 24.7, 24.8. So we're going to go ahead and round that up to 25. Cut all the stocks that have a price-earnings ratio greater than 25. Next, we're going to cut all the stocks that have a yield under 2% because the S&P 500 average right now is about 1.78. So I'm just going to go ahead and round that up to 2%, and then that'll be our next screening sort of process, financial metric to remove stocks from. From then on, we'll move on to their 5-10 year. We want to make sure that these stocks have all had increasing revenue, increasing net income, and increasing free cash flow over the last 5 or 10 years. These are great financial metrics to kind of measure dividend stocks, because you don't want stocks that have decreasing revenue, decreasing net income in times that we've, in the last couple of years, we've had great financial history so far. I don't know the word for it, but we should be looking for profitable companies that will continue to increase their dividend for the next several years to come. We want dividends that are going to be increasing by, say, 5% or more per year. So Apple, for example, just increased their dividend by 16% from 63 cents per share to 73 cents per share. So that was a 16% dividend increase. So that's what we're going to be screening for today. And of course, if you are brand new to my channel, I do make stock market, investment, and real estate related videos. So if you would, go ahead and like and subscribe to the channel for future financial videos. So without further ado, I'm going to go ahead and flip my screen around, showcase, and begin screening some of these stocks. So yep, stay tuned. Okay, so starting off, we're going to take a look at the S&P 500 PE and dividend yield. So right now, the S&P 500 PE ratio has an average of 24.68. So out of all the stocks within the S&P 500, the average it sits at is 24.68. So we've just rounded it up to 25. So just like in our screening, when we just kind of showcased at the beginning, we're looking for stocks with a PE under 25. Next, where's the S&P 500 yield right now? It's at 1.84. So it's a little bit off. Here you can see Black Tuesday, you can see Black Monday. They were a little bit higher. Right now we're trading at a dividend yield of 1.84%. So we're just kind of rounding it up. We want a 2% yield or greater in order to kind of pass our screening process. So next we're going to be screening stocks based on their strength. So how is strength measured? Well, we use the DARS Dividend Advantage rating system found over at dividend.com. This kind of measures the stock strength, attractiveness of its yield, reliability, whether it can continue to increase its dividends based on its earnings. It doesn't want a high payout ratio. I consider anything over 60% as pretty high. If they fall, due to the economy pulling back and their earnings per share drop, then their payout ratio may increase from 60% or lower. It could double. So if you have a stock such as Starbucks, I think their payout ratio is around 20%, and their earnings drop by half. Well, their payout ratio would double, so it'd go from 20% to 40% payout ratio, which isn't bad. They would still be able to pay out that dividend to their shareholders. So that's what you want. You want stocks that have reliability, and even in times of pullback and recessions can continue to not only continue to pay out their dividend, but continue to increase it, such as stocks such as Johnson & Johnson, Procter & Gamble, ADP have done for 30 plus years. Dividend uptrend, continuing to increase with the market, and earning growth. Over the next 4 quarters, are they expected to have continued earning growth? So that's basically what we're measuring for. And let's go ahead and begin our screening process. So starting over at dividend.com, we're going to go ahead and look up ex-dividend dates. And of course, I'm going to go ahead and just use common shares, look up from the 21st of May to the 25th. I think initially when I did my intro, I did 21 through 27, so 21 through 25, and then we're going ahead and search there. And then if you don't see the DARS rating here, That just means you have to create a logon for the site. It's completely free, and then you can do this screening process here like 2 or 3 times before you're kind of locked out for the day. So I always do it just one time every single week. That's where I cover it with you guys. So as you can see here, we have a number of stocks here. We have Hershey's Company, familiar names there. We have, let's see, do we have any other familiar names? Go ahead and use my keys. Kind of move down, and right off the bat, I don't recognize a whole lot of tickers. A lot of company names I don't really. Expedia's there. That's one I understand. Expedia, the travel site. But besides those, I thought that was Barnes and Nobles. Besides those tickers, I don't really recognize many others. Johnson & Johnson right there. So, as you know, this whole screening process, I like to do this every single week because I don't have, whatever is posted over on the media, Apple, Amazon, Netflix, Facebook, a lot of those stocks don't pay dividends, and a lot of stocks, there's thousands of stocks out there. Many of them aren't kind of broadcasted on the media. So by doing this, I'm doing my research every single week, looking up 50 stocks, 40 of them, 40 plus of them I've never even heard of, and then do a very, very quick screening process, of course, measuring for my my screeners here, my PE, my yield, my increasing revenue, net income, free cash flow, and then I look for stocks that are currently trading with a yield over price, and then I do a little bit more research as far as how many of them have been paying out dividends for more than 10 years or increasing dividends for more than 10 years, and kind of along those lines. So I'm going to go ahead and we're going to go ahead and punch in anything with a rating of 5 to 3.6. I think we have enough here. Yeah, right here, 3.6. Key Corp is the last 3.6, so it looks around 40 stocks. So all I'm going to go ahead and do is punch in these ticker symbols right here on the left-hand side and continue down the list. I'm going to go ahead and pause the video because these videos end up turning out to be 30 minutes long, so I'm going to try and cut them down as much as I can. So I'm going to go ahead and pause it right now. Okay, and we're back. So all I did here, I copied and pasted all of these from 5.0 to 3.6, put them into my Excel sheet, and we're screening 62 stocks right now. So we're going to go ahead. We have 62 stocks over here on the left. After I've kind of gone through these, some of the names that I did see that we're kind of covering are NVIDIA, Johnson & Johnson. We have, what was that one brand? Callaway Golf. I know Jeremy over at the Financial Education channel, he does that one. A couple other ones, Rugger & Co., so gun company, and a few others. So Dividend.com is a great website for checking out ex-dividend dates, general stock information. We'll use it again here towards the end, but for right now, we're just going to hop over to Y charts and begin doing our process. Now, we can only screen 12 stocks at a time, so what you want to do here is just measure 2, 4, 6, 8, 10, 12, and then we want to go ahead and deselect the remainder of these. So it's unfortunate that we can't screen all of these at once for their PE ratio, but there's just so many stocks here, 60 some stocks, and we can only screen 12 of them at a time because there's only 12 colors to kind of screen with. So now that I've got these all deselected, I'm going to go ahead and come down here to the top or the bottom to my financial metrics and select PE ratio. It's going to go ahead and load. So right off the bat, Johnson & Johnson, due to them reinvesting their earnings and the whole taxes that have been changed as of January, their price to earnings ratio is showing up very high. I'm not sure if that's 100% accurate. Let's see here and just bring up Morningstar here and look up J&J, and Johnson & Johnson is showing a PE ratio of, come on, let's see, PE, is it even? Price to book is 5 point. Okay, price to earnings, yeah, 237. So that's right. I'm gonna go ahead and just remove it, just because based off our financial metrics, Johnson & Johnson, it may kind of swing back down. The reason that it's jumped up so high is because they're reinvesting their earnings back into their company, and the way that the tax system's recently changed is kind of making that bug out here on all the charts here. So not that Johnson & Johnson is a bad company. It just does not meet my criteria that I'm currently screening for. And we have, 60 other stocks to look at and choose from. So not saying Johnson & Johnson is a bad stock, just saying at this current time it does not currently fit the financial metrics that I am screening these stocks for. So here all I'm doing is on the right hand side, as I'm selecting these stocks, it shows me what the PE ratio is. You take the color, you match it to the one here on the left here, and you kind of look at the number from top to bottom. This is number 4, so over here it's 4th from the bottom. You just sort of remove it from the list, and that kind of removes the stock. So I'm going to go through here and remove all the stocks here that have PEs greater than 25. So this process here takes about another minute or so. So I will be right back. Okay, and we're back. We have a list of around 20-30 stocks now, and all we've done is use PE ratio to knock them out. So next we're looking for dividend yields greater than 2%. Anything with a dividend yield less than 2% is going to go ahead and get removed from our list. So a couple of these actually showed up with having no dividend. So for example, Pandora, I'm not sure how it got on my list. I may have accidentally clicked that one on here, but it does not have a dividend yield. So all we go to is like Callaway. Okay, so Jeremy from the Financial Investor Channel, he doesn't do a lot of dividend stocks. He liked those growth stocks. So Callaway is considered a growth stock because it is still kind of, it's expanding and going into different areas. They just built some new one, I think is what I had heard from the other channel here. So I don't look into a lot of these stocks initially. All I'm doing is screening them for their financial metrics, and then once I have a good amount of stocks, this is sort of like a watch list, but this is this, every single week I'm getting new stocks to kind of watch, and that whole little process. So just about all these stocks here can get knocked out besides Haverty, which is right here. I'm just going to go ahead and deselect it, and the Scott's Miracle. So I'm going to go ahead and deselect it. So everything else has a dividend yield under 2. So I'm going to go ahead and just knock those out, and let's go ahead and pop these back in here. And let's see here. Purple is AFL, so that one's good. We got some green ones. Actually, I'm going to go ahead and pause the video and remove the rest of these stocks here that have yields under 2%. Okay, and we're back. So now we're left with 2, 4, 6, 8, 10, 12, 13 stocks that all have PEs under 25, dividend yields near or over 2%, like very close percentage-wise to being 2% and then greater. So at this point, all we're going to be doing is taking a look at the last 10 years, going by percentage change inside data format, and we want to look at revenue, free cash flow, and net income. What we want to do here is over the last 10 years, are these numbers positive? Yes, so the Carnival is positive. Horizons, it's not showing up in my charts, meaning that one of these is in the negative by a long shot here. So if we take a look here at free cash flow, net income, boy, nothing's showing up here on this graph. So I'm going to go ahead and just deselect that one and continue moving on here. So yeah, positive right there across the board. We got positive, look at that, free cash or net income up 918% over the last 10 years. Scott's Miracle, we have decreasing revenue but increasing free cash flow and net income. We have a couple stocks already that have that positive numbers. So there's decreasing free cash flow. That's not so bad, but again, we still have a number of stocks that we're screening for. So we're going to go ahead and just deselect those and kind of continue on here. I'm sure we're going to end up with at least 5 stocks that meet our criteria, and we're kind of getting there on the line. We have 4. Look at that. Free cash flow up 5.79,000% on Sturm, Ruger & Co. I believe that's the gun company for pistols and just weapons in general. And there we are. So we have 5 stocks that we're left with. So we have Carnival, Southside Bankshares, Duncan Brands Group, Aflac, and Sturmruger. So those are our 5 stocks with ex-dividends coming up next week that meet the criteria of PE under 25, yields greater than 2, increasing revenue, increasing net income, increasing free cash flow over the last 10 years. Now at this point, we are at 13 minutes, so we actually screened down to 5 stocks so we can take a little bit, we can gather a little bit more information now. So all I'm going to be doing is heading back over to dividend.com, opening up these stocks in another tab, and then we're going to take a look at how, what's their payout ratio, how long have they been increasing their dividends. AFL, for example, I believe they're at nearly 60 years. I've looked into them in the past. I've never actually owned them, but I know that they do have a long history of increasing their dividends. So we're done over here at dividend at Y charts. But one last thing I'd like to check out is yield and price, and go back to my data format original. So right here, Carnival looks at about, for the year, it's about even. The price has came down quite a bit as of January, and the yield, it's actually at one of the highest points within the last year right now. We have Southside. Yield is great. Right now the yield is at a greater point than it's been, besides that dip here in right at the beginning of May. It looks like it dipped where the yield was around 3.5%. The price dropped very quickly down from $35 per share all the way down to nearly $32.50 before recovering up to the $33.50. Dunkin' Brands, we have price over yield. AFL right now has had a very quick, as of July of 2017, this, prior to then, this stock has just been on the up and up. And it did have some major drops, during January, during February, during April here, but it's recovered very nicely. These are pretty tough swings, but at the same time, imagine if you average down on each one of these dips. If you're a long-term buy and hold investor and you're able to average down on these huge dips, you're getting those shares at a very nice discount. Right now, the dividend yield is at about a 2% right now, whereas in the past, it has been trading at a 2.25. This could still be considered, back in 2016, it looks like you get the stock at nearly a 3% dividend yield. And then we have the last stock here, price is over the yield. With, gun control being, a high topic recently, you could see the stock continue to increase as gun sales, as there's more gun sales, as they're trying to ban more and more guns and create more rules, against automatic pistols and firearms and all sorts of stuff. You could begin to see stocks with that sell and manufacture weapons increase in price. So those are our 5 stocks. Now I'm going to go ahead and expand my dividend.com, and now we have all 5 of these stocks here. And as you can see here, AFL is number 1 with 35 years of increasing their dividend. That's 35 years of not only paying out a dividend, but increasing their dividend every single year. And number 2, as far as continued growth, is Southside Bancshares. This is a regional, financial. It's a mid-Atlantic bank. A lot of these financial companies during the 08-09 crash, they cut their dividend or stopped paying dividend or froze their dividend. So this stock has continued to pay out during the 2000 crash, has continued to pay out through the 2008 crash. So there's 2 stocks right there that are very recession resistant. They also have payout ratios under 60%, which is what I like to look at. I like to invest in stocks. When I was investing in dividend stocks, that have a payout ratio of under 60%. So both of those stocks meet that criteria, and they both have dividend growth for the last 10 years, showing that they have increased or have paid out during recessions. Number 3 would be Dunkin' Brands. They've had dividend growth for 5 years. Their payout ratio still does match the under 60% rule that I like to follow. And number 4, we have Carnival Group. This is general entertainment, 3 years of continued dividend growth. Payout ratio, again, under 60%. And in last place, we have the sporting goods and, Strum, Ruggers & Co. They haven't increased their dividend year over year. They don't have any sort of growth. They do have a low payout ratio. So starting back at number 1, This one's ex-dividend is May 22nd, which is next Tuesday. So you do need to buy this stock on Monday or prior and then hold it until the ex-dividend date. You would then get paid out on June 1st. You would get paid out 26 cents per share. They just did a stock split. For every one that you had, they gave you two. So if you had 100 shares, you now have 200 shares that you would get paid out 26 cents for. So if you're an AFLAC holder, congratulations, they did a stock split. You got basically double your shares, plus they kept paying out that dividend of 26 cents per share. So if you had 500 shares of AFLAC, for example, let's do the math real quick. 500 shares, and you were getting paid out 26 cents per share. That's $130 for those 500 shares. But they did a stock split. They're giving you two for every one that you had. So essentially, you'd multiply this by two. Whoops. Now you have 1,000 shares, and you're still getting that 26 cents per share. So you just doubled your dividend payout, in a single instance. So now you're getting $260 of dividend payout. Plus, if you've held this stock for the last 10, 20 years, you've had that continued increase in dividends. So that's why this, it's been reinvested into itself and compounding year over year over year. And let's see, is that the last, the last time we did a stock split was back in 2001. So all those who had invested for the long term just got a very nice, doubling their initial, their dividend payout. So that's it for AFLAC there. Great looking stock for the long-term accident and health insurance. Number two, ex-dividends on the 23rd, which is Wednesday. So you got to buy this stock on Tuesday or prior. You'll then get paid out on the 7th of June. This stock recently did, it looks like it actually does these quite often, where it does a special payout where, for whatever reason, they decide to pay out 5 cents extra per share, 2 cents extra per share. Those are just extra dividends that the shareholder is receiving for buying and holding on to that stock for the long term. You also would get, they just increased their dividend from 28 cents to 30 cents. So what's that? Like a 10 cent, 5 to 10% increase right there. So if you had 100 shares and you're getting 30 cents now, that's $30. Instead of $28, they just basically increase your dividend by $2 for holding on to their shares. Plus, they do have those special payouts there. You can see them all over the chart here. So, very solid looking company right there. Regional, Mid-Atlantic Bank. Number three, we have Dunkin' Brands. Again, very good payout ratio. 5 years of dividend growth. This could be one if you're looking for a restaurant to kind of fit your needs. This could be one to kind of buy. The ex-dividend is on May 25th, which is next Friday. So you would have to buy this one on Thursday or prior. Then you would get paid out on June 6th. Take a look at its history here. So let's see here. They've had dividend growth since 2013. So kind of taking a look at 2013 here. What happened here in 2013? Oh, okay, so what happened here is prior to 2012, they never really increased. They never even had a dividend. So in 2012, they began paying out a dividend. They increased it in 2013, which is the start of their dividend growth. So this stock, it doesn't have any history through a recession, but since it initially started paying out dividends, it has continued to raise and pay out their dividend year over year. They currently pay out 34 cents and 75 hundredths of a cent for each share. So, and they have increased it. Let's see here. Yeah, they increased in 2017. They increased it in 2018. So you're more than likely, if you held it into 2019, you would probably get 36 cents per share, right around there. Looks like they bump it up by 2 cents each year. So that would be a nice little increase year over year. Number 4, we had Carnival Group, ticker symbol CCL. I mean, again, payout ratio under 60, dividend growth 3 years. This one has ex-dividend on May 24th, which is next Thursday, so you'd have to buy them on Wednesday or prior. You would then get paid out on the 15th of June. Now, their history has been a little bit rocky. You can see here that in 2009, they cut the dividend completely, kind of like GE has done, but they cut it down from 40 cents per share to nothing for about a year and a half. Looks like they cut it at the end of 2008. So 2009, they didn't pay out any dividend. Then in 2010, they dropped from 40 cents per share all the way down to 10. And then since that point in 2010, looks like they stopped paying out dividends during this time. So from 2011 to 2015, they continued to pay out that 25 cents per share. They did do a special payout there of 50 cents per share. And then as of 2015, afterwards, they increased their dividend. So that's the history there. They currently pay out 50 cents per share, which is similar to AT&T, if you're looking for that. And number 5, we have Strumberger & Co., ticker symbol RGR. Their ex-dividend is May 21st, which is Monday, so you would have to buy this stock on Friday or prior, and then you would get paid out the dividend on June 1st, and that would be 32 cents per share. You can see that this stock has bounced around quite a bit. 49, 41, 44, 48, 23, 21, 23, 32. It's very inconsistent here. So if you were a long-term buy and hold investor, this probably wouldn't be a stock you would be invested in for, the continued growth. You wouldn't have reliability and stability. This is one that I myself, for long-term investing, wouldn't consider adding to my portfolio. This could be one for the short term if they're trying to implement gun controls. Of course, that makes people want to go out and buy more guns. I know we're never going to, it won't get into all of that, but let's see here. They did do a special payout here of $4.50 per share back in 2012. So they may have had a lot of money coming in during that time and decided to do a special payout to their shareholders, and they paid out $4.50 per share. So that is it for this video. So stocks in order of dividend growth and payout history. We have number 1, AFLAC at ticker symbol AFL. Southside Bank Shares, ticker symbol SBSI. We have Dunkin' Brands, ticker symbol DNKN. Number 4, we have Carnival Corp, ticker symbol CCL. And in number 5, we have Strumberger & Co., ticker symbol RGR. So that is it for this video. If you guys did enjoy the video, remember to like, comment, and subscribe for future financial videos. If you guys own any of these stocks with ex-dividends coming up next week, go ahead and let me know in the comment section below. AFLAC looks like a very nice company for the long term. It has been having some recent dips, so it could be a good opportunity to wait until the next dip into the $43, $42 range before picking up some shares. But if you're trying to capture that dividend, it doesn't look like it's broke out past this $46 point, so this could be at a midpoint where, Anyways, so that is it for this video. At this point, whatever stocks you do decide to go and take a little bit further investigation as far as look at its balance sheet, look at its 10Ks, its last quarterly earnings, has it been positive over the last 4 earnings, or did it miss an earning or such, its earnings per share, how is their revenue done year over year, what are some of their weaknesses in their company, do they have a strong moat, and whatever else you guys would like to kind of measure your companies by. But those are some that I screen my stocks for. So that's it for this video. We are hitting right at 27 minutes, so we did beat the 30-minute timer. So that is it for this video. Thank you guys for tuning in. I will see you next time. Have a great day. Bye-bye.